Good morning, everyone. Welcome to the Morning Kappa at 8 on a Wednesday. I'm here to present the Midweek Futures Traders Technical Brief, and this is week 1 of August. On this page, so we have observed there's been some shifting of preference for different asset classes by traders. We have noticed that the favorite among all the products that we are covering are the indices, especially the Nasdaq and also the S&P 500. And as we notice here that it's been on a second week of uptrend, and noticeably too, it's getting to be a bit on the overbought side. For agris, we also noticed that from a positive profile, soybean oil and soybean has moved back to neutral, and crude oil had a move on the upside, but because of the pullback, it is still now trading on neutral. The metals too, we have basically seen silver having a good run, and it's maintaining a positive setup. So we move into our favorite product, local product. This is FCPO. And from the chart, we see that there has been a pullback after a very impressive run for FCPO. This now shows that it is setting up for another run-up, but the impact of the performance could be affected by the correction in soybean oil. So I think for palm oil, we should be looking at the lower end to be entering the market. And so basically the news that has been in the driving the prices has been the Malaysian palm oil exports, which have actually come down quite a bit. And also we have seen the premium of soya oil to palm oil is 241 metric tons, and this is much higher than the $29 from last year. And from here, we know that the commitment of traders have seen a little bit of a shift. The S&P 500 has registered an increase of estimated 18,000 in short positions, and both the Dow and the Nasdaq also had short positions trimmed by 6K and 1K respectively. And so this is the S&P 500, and the chart shows that there has been a pullback from the high, and the market is seen to be repricing after the non-farm payroll report on Friday. Only 73,000 new jobs were created, and it is a major downward revision from May to June. And also traders now see a 92.1% chance of a September rate cut, up from 38% previously. And also we are at the tail end of the reporting season. We have seen the US second quarter earnings. Basically, about 80% of the companies are beating the analyst profit expectation. So in other words, I see that most of the upside has been priced in, so a pullback is imminent. And this was actually shared last evening. And basically, S&P 500, we are looking at a negative setup. The current price of this morning is 6367 was last evening, and reference price 6330, and this has actually been hit last evening as well. So we are looking at a potential profit price of 6260, which will give us a value of $350, and a potential loss if it goes back above the 6395, and that is a potential loss of $325. So we look into metals. Commitment of traders gold saw short positions reduce, And copper too had similar actions, and silver remained relatively unchanged. So for gold, mainly it was driven by growing expectations of a US interest rate cut in September. And traders now are pricing in a 94.4% chance that the Federal Reserve will cut rates following a soft job reports that raised concerns about the US economic outlook. And for gold, we are looking at a negative setup as well because the profile generally is neutral. And so the potential of another downside short term is highly probable. So we do have a reference price of 3425, the current price at 3436. So this will give us a profit of 150 US dollar at a price of 3410 and potential loss price of above 3445, and that will be a value at 200 US dollar loss. So we are still seeing the high probability that gold will be trading in a range. So this is a range bound strategy that is being implemented here. So that's all I have for today. I'll pass on to Joseph. Thank you.
Morning, Navan. Thanks, Vincent, for the weekly futures update. So take a look at the Hang Seng Index. Yesterday, the index managed to stage a very strong rebound near the 50 days moving average. Right now, it's eyeing to cross above the 20 days moving average. But so far, we didn't see any strong or news from the China. Basically, what happened is that the selling pressure has tapered off yesterday. So basically, this week I'll be looking at more price actions to tell whether the Hang Seng will resume on the upside. Meanwhile, I'll pay attention to the banking stock this week. As I can see that most of the tech stock have undergoing corrections so far. Nevertheless, I'll set the stop loss point at 23,000 point. So far, we still keep a bullish trading bias on the Hang Seng Index. Meanwhile, looking at the Europe market, right? The Europe have underwent a very strong corrections last week, right after the tariff news has been announced. You can see that initially it went up to 550, but right now it actually pulled back towards the 535 level right now, and in tandem with the corrections, we also see that the XPX, which is the S&P 500, also have pulled back sharply over the last 2 days. Yesterday, the S&P have initially had a positive opening, right? But at the end of the sessions, it have give back intraday gains and close slightly lower as well. So it shows that the sentiment remains weak at this juncture. One reason is that you can see that for the past 2 sessions, the US 10-year yield has fallen sharply. Now, this is also after the US have announced a very weak set of labor data on the Friday. Yesterday, they also announced the weaker PMI on the services data by the ISM, right? And you can see that the sentiment remain cautious on the US right now, and market is trying to gauge what will be the impact after all these tariff is going to be implemented this Q3, right? And so far, if you read at the news, right, the Fitch rating have came out effective tariff rate for the US is, I mentioned that last year was 2%, and this year it's going to be at 17% on the total imports into the US. I think that while the market is digesting the effect of the tariff, right, whether it's going to impact on the consumer, whether the labor market is going to get weaker, right, next week, 12th of August, that will be the deadline between the tariff talk between the US and China. That will actually move the market again next week. So far, based on what I read on the weekend, right, the US official have mentioned that they may delay the tariff talk between the US and China beyond 12th of August. Nonetheless, right now, we look at the market. I think everyone is trying to gauge what is the US 10-year yield right now. As we look at the equities market, the pricing mechanism is actually derived from the 10-year yield level. So for our house, we think that the 10-year yield is going to be at 4.10 this year. We have actually adjusted upward from 3.8 previously. So let's see. We just have to wait for the 10-year yield to be stabilized, and we can see that US market to climb higher again. Yesterday night, market have boosted by another AI stocks, which is the Palantir, right? They have delivered a very good set of results. You can see that their revenue have break the 1 billion mark, although their forecast number only about 900 million. And the company have guided that this year they're going to deliver a full year of 4 billion on the top line. That have actually sent the share price to the record high. But so far, the other tech company such as AMD or even the AMD and the Amazon has been slightly conservative on their numbers, and you can see that these two, especially the Amazon, right, share price have pulled back sharply after the weak guidance from the company. As for the Malaysian market, I just want to do a comparisons on the indices that we have right now. So in Bursa, there are 13 indices, right? Look at the full year, right? The best performed since the beginning of the year is REIT that deliver about 8% return. Second is the constructions, and the worst is actually healthcare, right? And technology also a laggard, right? If you look at a year-to-date basis, but if we zoom in since June. Why I choose June? Because on the May, that was a MSCI rebalancing. So I think that since 1st of June, right, market have a little bit of different landscape. So we start to track from the 1st of June until today. We can see that the best performed sector is actually the constructions, right, followed by the utilities and technology. So you can see that despite that, the Naga share price have been pulled back, right? Some other components such as YTL Power and Randhill continue to support the utilities sector. And construction sector basically buoyed by the Gamuda, IJM, these two big player. And also can see that last week, Malaysia have also announced the 13 Malaysia plan. You can see that the construction sector continue to deliver very good sets of job wins so far. And fourthly, the REITs sectors continue to lead the market in these last 2 months, right? And for the past 2 months, the weaker sectors is the finance as well as the healthcare sector. Afterwards, Chun Song is going to share with us one of the healthcare stocks. So in terms of bank stocks, our research is a neutral call on the banking sector, but just bear in mind that coming to the month of August, usually is the month that the banks will announce dividends. So just watch out any banks that have actually oversold, they may have a counter-trend rebound due to the anticipations of the dividends payout. And so looking at the FKLI right now, the resistance remain at 1550. But based on the last 3 days price actions, I can see that the index have been moving upwards after the announcement of tariff. So Malaysia's we are going to pay about 19% for the exports in US. And if the breakout happens, right, the FKLI will be moving towards 1,006. But right now, before the breakout happens, we'll keep the barrier trading bias unchanged. Now, as for FCPO, a very strong price actions happened yesterday, right? Due to market anticipate that the biggest importer, India, right, their stock level is very low, right? Since their stock level is low and CPO price is discount to their competitive peers, right? That may actually prompt India to start import more CPO into the country, right? So after the news actually came out, right, the market reacted positively, but so far the FCPO have not break the 4,003 yet, so the immediate resistance will remain 4,003, followed by 4,004. So on the downside, a very strong support will be a 4,001. This is where previously FCPO actually break out in the month of early July. So as long as the FCPO stay above 4,001 level, we'll keep the bullish trading bias unchanged. Right. Next week, next Monday, the MPOB is going to release the July month export and production data. As for the watch list, this is the watch list that we have shared, updated until yesterday, right? And for trading stocks, we're looking at firstly the utility counters, YTL Power, breakout from 4 ringgit and 20 cents. So after breakout, YTL Power will be testing a 4 ringgit 35 cents and followed by 4 ringgit and 50 cents. Downside support is 4 ringgit and 5 cents. Secondly, we have KJTS, right? And a company that do on the industrial cooling system. They are breakout from 1 ringgit and 50 cents and heading towards 1 ringgit and 60 cents and followed by 1 ringgit and 70 cents. Downside support is marked at 1 ringgit and 40 cents. So we have two breakout stocks this morning. Firstly, YTL Power, followed by KJTS. So I'll stop here and pass on to Chun on the Hartalega result note.
Thanks, Joseph. Good morning, everyone. We have Hartalega first quarter FY26 result review this morning. So during the first quarter, they delivered a core net profit of 8 million. The numbers represent 7% of ours and 6% of street estimate. Result will be below expectations, primarily due to the cautious customer demand in response to the tariff uncertainty in the US. Apart from that, the persistent challenges in terms of cost pass-through, as well as the weak operating stats are some of the key factors that drove the earnings lower. If we look at the overall operating stats, sales volume was actually down by 3% quarter-on-quarter to 5.9 billion pieces. Meanwhile, ASP declined 3.6% quarter-on-quarter to $21.7 US dollar per thousand pieces. Outlook-wise, we expect the operating environment to remain challenging for second half of this year, primarily due to the escalated operating cost environment with the mandatory EPF contributions for foreign labor set to take effect in October, alongside with the increased costs brought by the expanded SSD. So post-result, we actually slashed our FY26 to FY28 earnings by 39%, 30%, and 25% after we lower our ASP and sales volume assumptions to align with the management guidance. After the earnings adjustment, we derive a lower DCF derived target price of 1 ringgit 14 cents from 1 ringgit 33 cents previously. We maintain sell call, and looking ahead, we expect Hartalega profitability to remain under pressure, no thanks to the various headwinds that we mentioned earlier. Yeah, that's it from us today. Thank you, everyone, and we'll see you again tomorrow.